We were about to shut Venmo down. The crisis that nearly erased a billion-dollar giant, it didn't begin with success. It began with silence, no investor calls, no new funding, no backup plan, inside a struggling startup. A quiet realization was spreading. This was the end. Venmo, now a household name tied to seamless digital payments, was, at one point, just days away from disappearing completely. Not declining, not restructuring, disappearing. There were no dramatic headlines at the time. No viral posts. No last-minute funding announcements. Just a small team, a drained bank account, and a decision already made. Shut it down. What happened next didn't follow the rules of business, finance, or even logic. It was a moment driven by instinct, one that defied legal caution, ignored conventional process, and ultimately rewrote the future of digital payments. The collapse no one saw coming in its early days. Venmo wasn't impressive. It wasn't scaling rapidly. It wasn't dominating headlines. It wasn't even stable. The product was still raw, the user base painfully small, around 3,000 active users, and the business model far from proven. In a market dominated by established financial institutions, Venmo looked like a fragile experiment. Behind the scenes, the situation was worse. Money was running out fast. Operational costs were mounting. Regulatory complexities, especially those tied to handling and transmitting money, added pressure the young team wasn't fully prepared for. Even banks, including Wells Fargo, weren't offering support. They were issuing warnings. Venmo needed to stabilize its financial position immediately or face consequences, but stabilization required money, and there wasn't any. Left the decision to shut it all down at some point. The internal conversation shifted. It was no longer about growth. It was about survival. Then, finally, it became about closure. The founders reached a conclusion few startups openly admit: they were done. Employees were told the truth. The company had run out of money. There would be no payroll, no continuation, no recovery plan. For the team, it was sudden. For the founders, it was devastating. Years of work reduced to a single outcome: failure. There was no guarantee anyone would step in. In fact, all signs suggested no one would, until one phone call changed everything. The call that reversed the ending. Ikram Magdan Ismail, one of Venmo's co-founders, reached out to Reddy, who would later become CEO of Pinterest and had deep experience at PayPal. The message was direct. Venmo had run out of money. The team had been let go. Most executives, faced with that information, would step back. A company in that condition isn't just risky, it's nearly unsalvageable. But Reddy didn't hesitate. Instead of asking for financial models or due diligence reports, he made a decision almost instantly. He would send money to cover payroll, a move that shouldn't have happened. There was one major problem: the acquisition deal wasn't finalized. From a legal standpoint, wiring money to a company you don't own, especially one on the verge of shutting down, is highly irregular. Reddy's legal team pushed back immediately. They warned him not to proceed. The risks were obvious. If the deal fell apart, the money could be lost. There would be no obligation for recovery. But Reddy saw something differently. To him, Venmo's value wasn't in its current numbers. It wasn't in its infrastructure or short-term performance. It was in the people. If the team disappeared, the product would collapse permanently. Whatever potential existed would vanish with them. So he ignored the warnings and sent the money anyway. 5 days from extinction. At that point, Venmo had less than a week to survive. The situation wasn't theoretical. It was immediate. Without that intervention, payroll wouldn't be met. Employees wouldn't return. Operations would cease. 5 days later, there would be nothing left. The funding didn't solve everything. It didn't fix the product overnight. It didn't erase the risks, but it bought something far more valuable: time. Time to stabilize. Time to rebuild. Time to rethink what Venmo could become. And in the startup world, Time can be the difference between failure and transformation. Growth built on desperation. Even before the crisis, Venmo's growth strategy was unconventional. There were no massive ad campaigns or polished marketing funnels. The founders relied on direct, almost improvised tactics. They would walk into bars and send small amounts of money, often just $1, to strangers, encouraging them to download the app and try it. It wasn't scalable. It wasn't efficient. But it worked, at least until the money ran out. When resources became even more limited, the team made a small but telling change. They reduced the minimum transfer amount to 1 cent, not to improve user experience, but to survive. Every cent mattered. Every new user mattered. This wasn't growth driven by strategy. It was growth driven by necessity. The feature that almost broke everything as the company struggled to find its footing. Another internal battle was unfolding, the social feed. Today, it's one of Venmo's most recognizable features, a public stream of transactions that adds a social layer to financial activity. At the time, it was deeply controversial. Some team members believed it violated user privacy. Others feared it would damage trust. There were serious concerns about whether people would accept their financial interactions being visible. The debate wasn't minor. It was intense. There were disagreements strong enough to push some employees to the edge of leaving. Even leadership had doubts. The feature felt risky, unpredictable, and potentially damaging, but there was one signal the founders couldn't ignore. The users who engaged with it didn't just like it, they loved it. That level of engagement became impossible to dismiss. So the team made a decision that would define the product's future. They kept the feed, the turning point. That decision changed everything. The social feed didn't just differentiate Venmo, it transformed it. It created a new kind of trust mechanism. Instead of relying on institutional credibility, Venmo relied on visibility. Users could see their friends using the app. They could observe real transactions happening in real time. That transparency built confidence in a way traditional financial apps never had. And slowly, the growth that once felt impossible began to accelerate. From fragile startup to industry power, Venmo didn't recover overnight. The path forward was still filled with uncertainty, experimentation and risk, but the foundation had shifted with support from Braintree and later integration into PayPal. Venmo began scaling at a pace that once seemed out of reach. What started as a near collapse turned into one of the most significant success stories in Fintech. The same company that couldn't meet payroll became a dominant force in digital payments across the United States. The hidden reality of overnight success from the outside. Venmo's rise can look inevitable, a smart idea, strong execution, rapid adoption, but that narrative leaves out the most important part. It almost didn't happen. There was no guarantee of survival, no certainty of success. At multiple points, the company was one decision away from disappearing entirely. The difference wasn't just strategy or timing. It was a combination of instinct, risk tolerance, and belief in something that didn't yet fully exist, a lesson written in risk. The moment Bill Reddy wired that payroll wasn't just a financial decision. It was a bet on a team that had already been told their journey was over, a bet on a product that hadn't proven itself, a bet made without the safety net of a finalized deal. In most cases, that kind of decision would be considered reckless. In this case, it changed everything. What this story reveals, the story of Venmo's near shutdown, exposes a reality rarely discussed in success narratives. The line between failure and success is often invisible until after the fact. At the time, the risks feel overwhelming. The odds feel impossible, and the decisions that define the future rarely look heroic in the moment. They look uncertain, they look dangerous, they look like mistakes waiting to happen. Final reflection today. Venmo processes billions in transactions and stands as a cornerstone of modern digital finance, but Behind that success is a moment that could have erased it entirely. A nearly empty bank account, a team sent home, a company preparing to shut down, and one decision that ignored every rule in the book, not because it was safe, but because it was necessary. That is the part of the story that rarely gets told, and the part that explains everything.